Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about each of the three sectors that typically hold up during an economic downturn, which are considered defensive sectors. Let's get started. This type of thinking should be kept in mind to maintain a long-term balanced portfolio and for when the economy starts to turn towards a potential recession. Certain sectors of stocks can perform better during tougher times, given the way people spend differently during recessions and times of potentially higher inflation. Both consumer and business spending will change and impact some companies and sectors more than others. As you might imagine, there's no single investment type that performs well across all market environments. While it's impossible to perfectly predict what will outperform and when, there are often patterns that investors can identify as signals or clues. Here are some pros and cons for defensive stocks. Pros: stability from large fluctuations in the overall market. Low risk, generally maintain their value over time. Outperformance during periods of economic decline could provide some balance to a portfolio that may have experienced losses from growth stocks during a recession. Defensive stocks also tend to have dividends. Cons: low growth will rarely experience rapid growth. Can be overvalued during periods of economic decline, largely from investors flocking to these stocks at the same time during economic decline. Underperformance during periods of economic growth could hinder portfolio performance during periods of economic growth. During periods of growth and expansion, technology, energy, growth, and value stocks tend to lead in terms of sector performance. In the current market environment, when corporate earnings are declining due to a combination of inflation, higher expenses, and reduced demand and spending, the market has shifted and the defensive sectors should outperform growth, value, energy, and tech stocks. Defensive stocks tend to perform well because consumers continue to spend money on these products and services even during recessions. The first sector I'll be talking about is consumer staples. Consumer staples are things that we use daily, like shampoo, toothpaste, paper towels, laundry detergent, to name a few items in this category. During a recession or in periods of economic growth, consumers will still spend on these items consistently. Generally speaking, there is not a substantial increase or decrease in demand for these daily essential products, which means you'll still brush your teeth, clean your clothes, and eat, no matter what is happening in the economy and stock market. One thing to note that can happen when consumers are tight on cash during recessions: they can often trade down from brand names like Tide or Gain to private label or generic products, meaning a store's in-house brand like 365 branded products at Whole Foods or Kirkland branded products at Costco, which often sell at significant discounts to name brand competitors. Try to keep an eye on stocks within this sector that potentially have high barriers to entry and limited competition from private labels. An example of this is the beverage industry, which is largely dominated by Coca-Cola and Pepsi. Every beverage has some kind of name brand, so private labels don't really fit into the mix in this subsector within consumer staples. Healthcare is the second defensive sector. Again, healthcare spending will not dramatically change during a recession or periods of economic expansion or growth. Within the sector, outperformance has been driven by the most defensive types of healthcare companies. This includes large-cap managed care companies, pharmaceutical companies, and pharmaceutical distributors. Managed care companies like health insurance networks are generally able to pass inflationary pressure onto customers through charging higher premiums to the employers they have contracts with. Utilities is the third defensive sector. Utilities have one major thing going for them: they really don't experience much earnings pressure like other companies. Both consumers and businesses will spend roughly the same amount on utilities regardless of economic activity. These companies tend to respond well to inflationary pressure because they pass the higher costs straight through to customers. This kind of pricing power is what makes utilities have so much resiliency during a downturn. The compelling long-term case for the sector is that the world is starting to transition from fossil fuels towards a more electric future, partially due to the adoption of electric cars. This is a fairly big tailwind for the sector in terms of electricity demand, which leads to earnings growth. There are also tax credits intended to accelerate the energy transition in the short term. Telecom companies tend to have pretty stable revenue, though consumers may choose to not upgrade their service or devices as frequently. They generally will not stop using the service. Discount retailers that have the benefit of economies of scale will do better during recessions because consumers tend to pivot towards value in their normal spending. They will benefit from having more competitive pricing than smaller retail competitors. To illustrate these three sectors outperforming the S&P 500, Here's a chart of the 1-year return of the S&P 500 compared against the 3 defensive sectors I talked about during this video. You can see here that utilities outperformed in general, which was even a bit of a surprise to me. I find utilities to not be particularly interesting, but the results say otherwise. Utilities, healthcare, and consumer staples tend to have very consistent performance during any economic conditions because they're always needed, whether the economic business cycle is in a growth phase, in a recession, or somewhere in between. These companies also tend to face less earnings risk each quarter when they report because of their consistent business. These are parts of the economy that often show resiliency during a downturn because consumers continue to spend money on these products and services even when times are tough. For example, with the healthcare sector, people take their prescriptions, medications, regardless if there is a recession or not. Same with hospitals. Demand is less volatile. As investors might expect, each of these 3 sectors has performed better than the overall market through the volatility that we've seen in 2022. But wait, there's more. The 4th option to consider, in my opinion, would be cash. Even though cash is not a sector, if you can build up or save enough cash, you can start taking advantage of other potential opportunities or sectors that might be going down while the market is under pressure and selling off. If you take cash and invest it while prices are relatively lower, whether it's a sector of stocks or an index, that can grow into a fairly large sum over a long period of time. There's a saying that the real money is made when everyone is running for the exits. Just something to keep in mind, that averaging down or buying the dip in a long-term investing mindset makes a huge difference. Here's an example showing what $10,000 invested over a 10-year period looks like with a 7% rate of return with no additional contributions. You nearly double your money in that time frame. If you take that same $10,000 and leave it invested for 15, 20, or 30 years, in 15 years you nearly tripled your money. At 20 years you're at close to $40,000, and at 30 years, because of compounding, it would have grown to over $75,000. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.